Hello and welcome to Dennis Lee's Forex videos. In today's topic, we will be looking at the Dynamic Breakout Strategy II. So as an introduction, what is Dynamic Breakout Strategy II? Okay, this strategy is based on the tried and tested Donchian Channel Strategy, or DCS. Remember how the DCS works? Basically, it buys when the high of the day penetrates the highest high price of N bars back. And on the flip side, it sells when the low of the day penetrates the lowest low price of N bars back. As we will see later, this strategy works better with trending currencies such as the pound USD, which vastly outperforms volatile currencies such as the pound yen. Just a note, this strategy originated from George Pruitt and John Hill's book titled Building Winning Trading Systems with TradeStation, and it was adapted for the MetaTrader 4 platform. As you will discover, if you optimize the value of N to determine the look back period, that different markets work better with different parameters. Also, a particular market goes through different cycles and works better with different parameters through time. So that is a major limitation of version 1 of the DBS strategy, with using a static value of N for all markets and periods. In Dynamic Breakout Strategy 2, we used market volatility to determine the look back period, or N. So we will now look at the methodology of the trade setup and the dynamic exit. The original version 1 of DBS made its buying and selling decision solely based on the highest high and the lowest low values. In DBS 2, the same entry technique is used in concert with a Bollinger Band, which works as follows. For a buy setup, the close price of previous bar must be above the upper band, and on the flip side, for a sell setup, the close price of the previous bar must be below the lower band. Once the buy setup has been established, for a buy trade, the ask price must be above the highest high of N bars in order to open a trade. On the flip side, once a sell setup has been established, then the bid price must be below the lowest low of N bars in order to open a sell trade. Note that the calculation of the Bollinger Band uses 2 standard deviations and also the value of N, which is determined by the market volatility. One of the limitations of version 1 of Dynamic Breakout Strategy is that a fixed money management stop was put in place. In Strategy 2, we incorporated a dynamic trailing stop. The exit point is determined by calculating a simple moving average of closing prices for the past N bars. So, for a buy trade, the bid price must be below the average price in order to close the trade. On the flip side, for a sell trade, the ask price must be above the average price in order to close the trade. Note that N is determined by the market volatility. Here we will be looking at the expert advisor. In MetaTrader, we click on the expert advisors and we then attach the Dynamic Breakout Strategy EA onto a chart as follows. This will pop up a dialog box with the parameters. The first parameter is lot, which determines the number of lots per trade, and we will change that to 1. The magic number uniquely identifies this particular instance of the EA, which is 2060 by default. The ceiling parameter determines the highest value for N, or the look back period, which is 60. The floor parameter determines the lowest value for N, which is 20. Note that N is not an input here, but it is calculated dynamically with an initial value of 20. The band deviation parameter determines the standard deviation of the Bollinger Band, which is 2. So we have the EA attached to the Euro USD daily chart here, and we are running a backtesting strategy on this EA, and we are in the visual mode where we can adjust the slider from slow to fastest. The EA has several information that are displayed on the top left corner. The lot info was discussed previously, which is 1. The look back is calculated based on the volatility, which is 24 at the moment. The ceiling and the floor was discussed previously, which is 60 and 20 respectively. The high price is the highest high of N bars, which is 1.27218. The low price is calculated by finding the lowest low of N bars, which is 1.19021. The upper band is the upper limit of the Bollinger Band for N bars, which is 1.27414, and the down band is the lower limit of the band, which is 1.19483, and the exit price is calculated as the simple moving average of N bars. The rightmost bar is bar 0, the previous bar to the left is 1, the high of this candle is the highest high of the last 24 bars. The next bar to the left is 2, followed by 3, and so on. At N equal 24, we find that the low of this candle is the lowest low of the look back period. As N increases, the number of bars included in the calculation increases, which means that it becomes more difficult to open a trade. In this example, we see that the previous candle has closed above the upper band, and therefore this sets us up for a buy trade. During the current candle, if the ask price goes higher than the highest high of the last n bars, we will enter a buy trade. However, if during this candle the ask price does not go higher than the highest high, then this invalidates the previous trade setup, and we do not open a buy trade. So we will now fast forward to see what happens. So as you can see that the buy was bought at the highest high price. From our previous buy example, we will look at how the trade closes. We have drawn a moving average indicator as indicated by the yellow line. When the bid price of the candle closes below the moving average, the trade will close. So we will fast forward to see what happens. As you can see, the candle has moved below the moving average, and based on our exit condition, this has been met, and therefore the trade closed. In this section, we look at the backtesting results performed on 7 major currency pairs. We will look at both LIP's results as well as my results. LIP's period of testing is from 1st of January 1975 to 30th of June 2010. In his results, all currencies except the pound yen had a positive total net profit. Also, trending currencies such as pound USD vastly outperforms volatile currencies. In my results, we performed the backtesting from 1st of July 2010 to 25th October 2011. Compared to LIP's results, the percentage win decreased for most currencies. The 3 currencies that survive both backtesting results are Euro USD, USD Swiss, and the Pound USD. Based on the efficiency ratio, this strategy is recommended for Euro USD and Pound USD. In the next section, we look at several enhancements. First, we can measure market volatility by using different calculations instead of the standard deviation, such as average range, average true range, and the standard deviation of change in closing prices. Second, we could add an indicator to determine whether or not the market is trending. This will prevent the EA from trading during a ranging market. Third, we could change the indicator used to determine the exit price. There were trades which could have been closed for a higher profit. Unfortunately, the simple moving average has a long lag to the current price. This can be overcome by using an exponential moving average, which has a shorter lag. Hence, profitable trades are taken earlier. And finally, we could reverse the signals to create a counter trending strategy, which can then be used with volatile currencies. This concludes our presentation. If you have any feedback or questions regarding this video, you can either email me or write a comment on my YouTube channel. Thank you for watching this video.